General Electric was once the most valuable company in America. It built turbines, it built jet engines, it built medical scanners. It also built a financial empire inside an industrial giant. For decades, complexity masked fragility. Earnings were smoothed. Debt accumulated quietly. Financial engineering supplemented industrial performance. Investors saw stability. Rating agencies saw diversification. But complexity is not the same as resilience. When financial markets tightened and industrial cash flows weakened, leverage surfaced. The problem was not one division, it was structural dependence on financialization. General Electric did not collapse overnight. It slowly unwound an empire built on internal leverage and capital opacity. General Electric was founded in 1892 through the consolidation of Edison General Electric and Thomson Houston. The merger created an early industrial platform built on electrification. From the beginning, scale was strategic. The company standardized equipment across power systems and manufacturing networks. It operated in heavy industry where capital intensity created barriers to entry. Over the 20th century, General Electric expanded methodically. It entered power generation equipment. It entered aviation propulsion. It entered medical imaging. It entered transportation and infrastructure systems. Each division required engineering depth and long investment cycles. Cash flows were tied to physical assets. Revenue growth depended on industrial demand and global expansion. By the post-war era, General Electric had become embedded in national infrastructure. Its turbines powered cities. Its jet engines powered commercial aviation fleets. Its healthcare equipment entered hospitals worldwide. Operational complexity increased, but it remained industrial in nature. The conglomerate model accelerated under diversified leadership strategies. Business units were evaluated through centralized performance systems. Capital allocation became a core executive function. General Electric was not only manufacturing equipment, it was managing a portfolio of industrial cash flows. By the late 20th century, management systems were as important as engineering. Financial metrics began guiding strategic decisions. Return on equity became a dominant measure. Earnings consistency became a signaling mechanism to investors. The company's scale allowed it to access capital markets efficiently. It could borrow at favorable rates due to its perceived stability. Credit ratings reflected diversified industrial exposure. By the early 2000s, General Electric's market capitalization exceeded $600 billion. It was considered a benchmark for operational excellence. Institutional investors viewed it as a core holding. Analysts treated it as a proxy for industrial America. Yet beneath the industrial identity, the internal structure was evolving. Capital allocation increasingly blended operational performance with financial optimization. Industrial divisions generated long-cycle revenue streams, but financial activities began to supplement those streams. The balance sheet expanded alongside global operations. Debt levels increased gradually. Leverage appeared manageable within a diversified portfolio. Complexity was framed as strength. Cross-subsidization between divisions was normalized. Internal capital markets redistributed liquidity. Reported earnings demonstrated consistency across cycles. The conglomerate structure created resilience during isolated downturns, but resilience was increasingly dependent on internal financial flexibility. The industrial giant was becoming financially integrated. Structural takeaway: industrial scale can obscure the gradual financial integration of operational businesses. As industrial operations expanded, General Electric identified an additional opportunity. Customers purchasing equipment often required financing. Large turbines, aircraft engines, and medical systems involved substantial upfront cost. Providing credit could accelerate sales. In response, GE Capital grew from a support function into a strategic division.
Initially, financing activity was directly tied to industrial products. Loans were structured around equipment purchases. Risk appeared contained within asset-backed exposure. Over time, the financing arm expanded beyond internal customers. It entered commercial lending. It entered consumer credit markets. It entered real estate financing. It entered structured financial products. GE Capital began operating as a standalone financial institution. Its balance sheet grew rapidly during the 1990s. Funding costs remained low due to the parent company's credit rating. Short-term borrowing financed longer-term assets. Return on equity within the finance division exceeded industrial averages. Management recognized the profitability differential. Financial earnings began contributing a significant portion of total corporate profit. By the early 2000s, GE Capital was a major earnings driver. Industrial volatility could be offset by financial income. Earnings predictability improved. Quarterly results met or exceeded expectations with consistency. Investors rewarded the blended model. The conglomerate narrative shifted. General Electric was no longer only an industrial manufacturer. It had become a hybrid industrial financial enterprise. Leverage increased within the financial subsidiary. Liquidity management became more complex. Exposure extended across credit markets. Asset quality was tied to macroeconomic conditions. Risk models projected stability under normal market cycles. The parent company guaranteed confidence through its brand and rating. Internal reporting aggregated industrial and financial performance. External disclosure simplified risk presentation. Capital markets perceived diversification benefits, yet diversification masked correlation risk. Industrial customers and credit markets were not fully independent. When credit conditions expanded, both industrial sales and financing thrived. The structure amplified growth during favorable cycles. Financial returns improved consolidated metrics. Executive incentives aligned with earnings performance. Scale in finance reinforced scale in industry. The balance sheet deepened. Funding structures lengthened in complexity. Liquidity relied increasingly on continued market access. What began as customer financing evolved into systemic financial exposure. The industrial identity remained visible, but the earnings engine was shifting. Structural takeaway: when financing evolves from support function to profit center, leverage becomes embedded within the corporate core. As both industrial and financial divisions expanded, organizational complexity intensified. General Electric operated across dozens of business units globally. Each division reported through layered management systems. Capital flowed internally between segments. Industrial profits could be redirected to support financial growth. Financial earnings could offset industrial cyclicality. The conglomerate structure appeared balanced. Diversification reduced perceived volatility. Executives emphasized portfolio theory as a strength. Risk was distributed across sectors. Yet distribution does not eliminate systemic exposure. Internal capital markets reduced transparency. Cross-segment guarantees linked liabilities. Financial subsidiaries relied on the parent's credit standing. Industrial units relied on centralized treasury management. Cash management became consolidated. Debt issuance was coordinated at the corporate level. Complexity increased reporting demands. Financial statements grew longer. Segment disclosures became more intricate. Analysts relied on summarized performance metrics. Earnings guidance reinforced predictability. Quarterly targets shaped internal discipline. Performance management systems incentivized consistency. Meeting expectations became a strategic objective. Operational decisions were filtered through financial impact. Industrial investments were evaluated against return thresholds influenced by financial benchmarks. Capital allocation favored higher yield opportunities. The finance division frequently outperformed industrial returns. This created internal asymmetry. Management attention increasingly gravitated toward financial profitability. Industrial operations required long development cycles. Financial products adjusted faster to market conditions. Short-term financial gains improved consolidated optics. Leverage ratios appeared stable when viewed in aggregate, but aggregation concealed concentration. Funding exposure accumulated in wholesale markets. Liquidity was dependent on rolling short-term obligations. Balance sheet expansion accelerated through structured vehicles. Off-balance sheet exposures increased complexity further. Risk models assumed continued access to credit markets. Stress scenarios were limited to historical volatility bands. Correlation between divisions was underestimated. When credit expanded, industrial demand also expanded. The cycle reinforced itself. Complexity became self-validating. Performance reinforced the strategy. External observers saw diversification. Internal structures saw interdependence. Structural takeaway. Conglomerate complexity can create interdependence that is mistaken for diversification.
As the conglomerate structure matured, a culture of earnings precision developed. Quarterly performance became central to executive credibility. Meeting or exceeding guidance was treated as operational discipline. Internal forecasting systems were refined to reduce variance. Volatility was managed through portfolio adjustments. Industrial timing differences could be offset by financial revenue. Revenue recognition policies were applied within accounting standards. Long-term service contracts allowed revenue smoothing across years. Financial gains could supplement operational shortfalls. Asset sales occasionally supported reported performance. Reserves were adjusted within acceptable accounting frameworks. The objective was consistency. Analysts valued predictability over volatility. Stock price stability reinforced executive authority. Credit ratings benefited from steady earnings patterns. The market rewarded the appearance of control. Internal dashboards emphasized earnings per share targets. Capital allocation decisions considered their effect on quarterly optics. Industrial investments were sometimes deferred to protect margins. Financial operations provided flexibility in timing results. Short-term funding costs remained low in stable markets. Refinancing risk was minimal during expansion cycles. As long as markets remained liquid, smoothing mechanisms functioned. Complexity made direct assessment difficult. Segment-level profitability required technical interpretation. Investors relied on consolidated metrics. Balance sheet growth appeared aligned with corporate scale. Leverage ratios were presented in context of diversified operations. The finance arm continued expanding asset portfolios. Return metrics remained elevated relative to industrial peers. Incentive structures rewarded performance alignment with guidance. Executive compensation reflected earnings consistency. Internal discipline focused on meeting targets. Over time, smoothing became embedded behavior. Industrial volatility did not disappear. It was redistributed. Financial engineering complemented operational engineering. Transparency decreased incrementally. Risk perception declined as consistency persisted. Analysts adjusted valuation models to stable expectations. The conglomerate narrative reinforced durability. Yet stability required active management intervention. Without smoothing, earnings would have shown higher cyclicality. The system depended on continuous calibration. Operational performance and financial structuring became interwoven. Reported results reflected coordination rather than isolation. Structural takeaway. A culture of earnings smoothing can institutionalize financial adjustment as a substitute for operational volatility. By the mid-2000s, GE Capital had become deeply integrated into global credit markets.
Its asset base extended across commercial loans, consumer finance, and real estate exposure. Funding relied heavily on short-term wholesale markets. The parent company's high credit rating lowered borrowing costs. Short-term liabilities financed longer-duration assets. This structure increased maturity mismatch risk. As long as liquidity remained abundant, refinancing was routine. Commercial paper markets absorbed large issuance volumes. Institutional investors treated GE Capital paper as high quality. The balance sheet expanded alongside favorable credit conditions. Leverage increased within acceptable rating thresholds. Risk models assumed diversified exposure across sectors and geographies. However, diversification did not eliminate systemic credit risk. Real estate concentrations rose during expansion years. Consumer credit exposure increased through subsidiaries. Structured finance positions added layered complexity. Off-balance sheet entities were used for specific financing structures. These vehicles reduced apparent leverage at the consolidated level. Liquidity management required constant access to funding markets. Industrial divisions relied indirectly on centralized treasury operations. Cash flow interdependence increased between segments. When credit spreads narrowed, funding costs remained contained, but spread compression masked sensitivity to market stress. Internal stress tests reflected historical volatility assumptions. Extreme market dislocations were considered low probability. Capital buffers were calibrated to expected scenarios. The conglomerate narrative reinforced resilience. Yet resilience depended on continued funding access. Industrial performance alone could not support the finance arm. Financial profits were increasingly structural to overall earnings. The corporation's aggregate leverage was larger than industrial assets suggested. Balance sheet opacity limited external clarity. Analysts evaluated ratios but often lacked full asset transparency. Credit agencies maintained high ratings based on scale and history. Investor confidence remained intact. Equity valuation reflected blended industrial and financial strength. The market capitalization remained elevated in the early 2000s, but internal leverage exposure was cumulative. Funding structures were layered across instruments and maturities. Short-term obligations required constant rollover. Asset valuations were linked to market liquidity. The system functioned efficiently under normal conditions, but it assumed continuity of credit access. When liquidity tightens, maturity mismatch becomes visible. Leverage that is manageable in expansion becomes restrictive in contraction. Structural takeaway. Hidden leverage emerges when maturity mismatch and funding dependence are embedded within corporate structure.
In 2008, global credit markets contracted rapidly. Liquidity in short-term funding markets deteriorated. Commercial paper issuance became constrained. Funding costs increased across financial institutions. GE Capital relied heavily on these same markets. Refinancing risk materialized within weeks. Asset-backed securities markets stalled. Counterparties reassessed exposure to structured products. Industrial demand simultaneously began to weaken. Orders for large equipment slowed. Aviation demand softened. Energy markets entered volatility. Cash inflows across divisions tightened. The hybrid model faced simultaneous stress. Financial liabilities required rollover. Industrial cash flows declined. The diversification narrative weakened. Correlation between divisions became visible. Liquidity pressure required external support. Government-backed programs were accessed to stabilize funding. Investor confidence declined sharply. Equity valuation contracted. Credit spreads widened materially. Rating agencies revised outlooks. The company's balance sheet was reassessed. Short-term funding structures proved vulnerable. Internal liquidity buffers were tested. Dividend sustainability came into question. In 2009, the dividend was cut. The reduction signaled structural strain. Capital preservation became priority. Asset sales were considered. Financial assets were reviewed for disposal. Industrial operations initiated cost reductions. Workforce adjustments were implemented. Restructuring charges increased. The conglomerate structure became harder to defend. Market capitalization declined significantly from earlier peaks. The early 2000s valuation above $600 billion was no longer sustainable. Equity investors recalibrated risk expectations. Debt markets demanded higher compensation. Internal leverage amplified the downturn. The finance division required stabilization. Industrial recovery was gradual. The hybrid model faced credibility erosion. Leadership confronted structural imbalance. The crisis did not create leverage, it revealed it. Financial dependence had accumulated during expansion. Stress exposed maturity mismatch. The system required simplification. Structural takeaway: external shock reveals leverage that expansion conditions concealed. Following the financial crisis, capital preservation became central to strategy. Management prioritized balance sheet stabilization. Dividend policy was reassessed under constrained liquidity. In 2009, the dividend was reduced to conserve cash. The cut altered investor perception. Income-oriented shareholders recalibrated expectations. Equity valuation reflected reduced confidence. Industrial recovery remained uneven. Power generation demand fluctuated with global growth. Aviation markets recovered gradually but cyclically. Healthcare equipment orders stabilized but did not accelerate rapidly. Financial operations required continued deleveraging. Asset portfolios were reviewed for sale. Non-core positions were identified. Risk-weighted assets were reduced incrementally. Liquidity buffers were increased. Funding maturities were extended where possible. Reliance on short-term wholesale markets decreased slowly. Credit ratings remained under pressure. Each rating review affected borrowing costs. Interest expense absorbed greater portions of cash flow. Internal capital allocation tightened. Industrial divisions faced stricter return thresholds. Investment cycles slowed. Cost reduction programs were implemented. Operational restructuring charges increased. Portfolio simplification became an explicit objective. The conglomerate narrative shifted toward focus. Financial scale was no longer framed as advantage. Instead, it was framed as exposure. Market capitalization remained far below its early 2000s peak. Investor trust required rebuilding. Earnings volatility persisted. Guidance became more conservative. Dividend sustainability was revisited in later years. Subsequent reductions reinforced structural stress. Management credibility faced scrutiny. Board oversight intensified. Capital allocation decisions were evaluated under tighter liquidity constraints. The company initiated multi-year restructuring initiatives. Financial assets were divested over time. Industrial units were separated from financing operations. The corporate center reduced scope. Debt reduction became a primary metric. Liquidity discipline replaced growth ambition. Complexity was gradually unwound. However, unwinding scale takes time. Residual obligations constrained flexibility. Structural fragility was not resolved immediately. The balance sheet required sustained repair. Structural takeaway: dividend pressure exposes whether earnings are supported by durable cash flow or financial structuring. With dividend pressure established, management accelerated asset sales. Portfolio rationalization became a strategic priority. GE Capital assets were divested in stages. Commercial lending portfolios were reduced. Real estate holdings were sold.
consumer finance operations were separated. Proceeds were directed toward debt reduction. The balance sheet contracted. Reported leverage ratios improved gradually. However, asset sales reduced earnings capacity. Revenue streams narrowed. Industrial divisions faced standalone performance scrutiny. Power segment margins declined amid global oversupply. Energy transition dynamics altered demand forecasts. Legacy turbine contracts carried long-term service obligations. Cash flow timing became more uncertain. Aviation remained cyclical. Healthcare provided relative stability but limited scale offset. Restructuring charges persisted across reporting periods. Accounting adjustments reflected portfolio realignment. Goodwill impairments reduced book equity. Market capitalization fluctuated with restructuring announcements. Investors evaluated the sustainability of the new structure. Cost reduction programs intensified. Headcount reductions occurred in multiple divisions. Facilities were consolidated. Corporate overhead was trimmed. Operating margins were recalibrated. Capital expenditure was disciplined. Debt maturities were extended where possible. Liquidity buffers were maintained conservatively. However, asset disposals reduced diversification. The conglomerate discount became evident. Analysts began valuing divisions independently. Breakup discussions entered strategic dialogue. The corporate center reconsidered integration benefits. Industrial focus replaced financial expansion. Risk concentration shifted from finance to operational execution. Capital allocation emphasized core competencies. Balance sheet repair required multi-year discipline. Credit outlook stabilized gradually, yet equity recovery remained limited. The early 2000s valuation was not restored. The company was smaller in scale. Financial opacity reduced, but earnings power was also reduced. The transition was structural, not cosmetic. Operational performance now carried greater weight. The hybrid model was effectively dismantled. Structural takeaway: asset sales can reduce leverage, but also permanently alter earnings capacity and strategic scale.
Leadership transition became central to the restructuring phase. Executive turnover followed periods of underperformance. New leadership inherited a balance sheet under repair. Strategic messaging shifted towards simplification. Operational transparency was emphasized. Capital allocation discipline was reinforced. However, structural challenges remained embedded. Legacy liabilities constrained flexibility. Long-term service contracts required sustained execution. Industrial margins were under competitive pressure. Energy markets were evolving toward renewables. Power division write-downs reflected asset revaluation. Impairment charges reduced reported equity. Investor confidence required consistent delivery. Credibility was rebuilt incrementally. Management narrowed strategic focus. Non-core units were earmarked for separation. Internal reporting was reorganized. Segment-level accountability increased. Financial metrics were reframed around cash flow. Free cash flow became a primary communication tool. Debt reduction targets were publicly stated. Liquidity preservation remained non-negotiable. The market evaluated execution against stated milestones. Volatility persisted in equity pricing. Aviation recovery timelines shifted with macro conditions. Healthcare performance provided relative stability. Cost control initiatives continued. Corporate overhead declined further. Cultural adjustments accompanied structural change. Decision-making became more decentralized. However, prior complexity left residual inefficiencies. Systems integration required modernization. Digital investment competed with deleveraging priorities. Capital expenditure was balanced against liquidity needs. Market capitalization remained below historical highs. Investors recalibrated long-term growth expectations. The conglomerate premium had disappeared.
Valuation increasingly reflected standalone industrial risk. Credit ratings stabilized but did not fully recover. Access to capital improved gradually. Yet the organization remained in transition. Breakup discussions intensified internally. Board oversight emphasized strategic clarity. Leadership framed separation as value realization. The objective shifted from scale to focus. Structural adjustment required sustained governance alignment. Execution risk remained significant. The company was no longer defined by financial expansion. It was defined by controlled contraction. Structural takeaway: leadership transition cannot eliminate embedded leverage, but can realign governance toward structural simplification.
By 2021, structural simplification moved from discussion to execution. The board approved a formal breakup strategy. General Electric would separate into distinct public companies. Healthcare would become an independent entity. Energy and power operations would form a dedicated business. Aviation would remain as a focused industrial platform. The decision acknowledged the limits of conglomerate integration. Capital allocation would become division-specific. Balance sheets would be separated. Debt would be apportioned across entities. Investors would evaluate businesses independently. The breakup aimed to eliminate internal capital cross-subsidization. Transparency would increase through standalone reporting. Management incentives would align with focused operational performance. Market valuation would reflect segment fundamentals. Execution required complex financial structuring. Legal separation processes were initiated. Asset transfers were organized by segment. Intercompany obligations were unwound. Shared services were redistributed. Treasury functions were restructured. Credit profiles were reassessed. Standalone liquidity facilities were arranged. Governance frameworks were rewritten. Boards were constituted for new entities. Operational continuity was prioritized. Employees were reassigned across corporate structures. Systems were partitioned. Brand identity was adjusted for successor companies. Investors recalibrated expectations. Market capitalization redistributed across the new entities. The original conglomerate identity dissolved. Complexity was reduced structurally. Financial opacity declined. However, the breakup did not erase historical leverage. Residual obligations remained allocated. Debt burdens differed by segment. Execution risk persisted through transition. Market conditions influenced valuation outcomes. Focused structures improved analytical clarity. Industrial performance became directly observable. Capital discipline became externally measurable. The conglomerate premium was replaced by operational scrutiny. Scale was reduced. Integration benefits were relinquished. The new structure prioritized transparency over diversification. Corporate identity shifted from empire to specialization. Structural takeaway: breakup can restore clarity, but it cannot reverse the cumulative effects of prior leverage. General Electric's trajectory reflects structural evolution across decades. Founded in 1892, it built industrial scale through electrification. Over time, it layered financial expansion onto industrial capacity. GE Capital became a central earnings engine prior to 2008. Financial returns exceeded industrial margins. Leverage expanded within acceptable rating parameters. Complexity increased across reporting segments. Earnings smoothing reinforced investor confidence. Market capitalization exceeded $600 billion in the early 2000s. The conglomerate model appeared durable. However, funding structures relied on continued credit access. Short-term liabilities financed long-duration assets. Maturity mismatch accumulated gradually.
Correlation between industrial demand and credit markets was underestimated. When the 2008 financial crisis emerged, liquidity contracted, funding costs increased, asset valuations declined. Dividend cuts in 2009 signaled capital strain. Subsequent reductions reinforced structural weakness. Asset sales reduced leverage but compressed earnings capacity. Leadership transitions recalibrated strategy. Restructuring charges persisted across reporting cycles. Market capitalization declined materially from peak levels. Breakup strategy was announced in 2021. Separation into focused entities proceeded through 2022. Transparency improved through standalone reporting. Operational performance became directly measurable. Debt was redistributed across successor companies. The industrial identity remained, but the financialized conglomerate structure ended. Scale did not prevent vulnerability. Diversification did not eliminate correlation. Financial engineering supplemented industrial returns. It also amplified exposure. Leverage remained manageable during expansion. It became restrictive under stress. Complexity delayed recognition of structural imbalance. Market confidence masked internal fragility. Corporate governance adapted after exposure became visible. Balance sheet repair required sustained contraction. The empire did not fail abruptly. It contracted through structural adjustment. The case illustrates cumulative leverage rather than sudden collapse. Financialization altered risk distribution. Hybrid models require disciplined liquidity management. Industrial strength does not neutralize funding risk. Complexity can amplify leverage. Corporate collapse is structure meeting stress. Structural takeaway: complexity can amplify leverage, and corporate collapse is structure meeting stress.